Still thinking the Canadian housing market is your biggest financial worry? Here's what actually happened this quarter that changes everything for your mortgage approval chances. Look, I need to talk to you about something serious that's happening right now. Equifax just dropped their third quarter report, and honestly, 1 in 20 young Canadians missed a credit payment last quarter. Let that sink in. We're talking 1.45 million missed payments across Canada. That's not a small hiccup, that's a wake up call. And here's the thing, this directly affects your ability to get approved for a mortgage or refinance your home. But here's what most people don't understand. If you're between 26 and 35, your age group saw delinquency rates jump over 20% compared to last year. The younger group, 18 to 25, up almost 17%. This isn't just a statistic. This is your competition in the mortgage market, and lenders are absolutely paying attention. Now, plot twist, the average Canadian is now carrying $22,321 in non-mortgage debt. That's up over $500 from last year. Credit cards, car loans, personal loans, all of it. And total consumer debt, we're sitting at $2.62 trillion nationwide. Here's why this matters to you specifically. When you apply for a mortgage, lenders look at something called your debt to income ratio. Every dollar of debt you're carrying makes it harder to qualify or gets you a higher interest rate. With debt levels climbing and missed payments surging, banks are getting more conservative with approvals. Let me give you a concrete example. Say you're earning 80 grand a year and you've got $20,000 in credit card and car loan debt. That might have been manageable for approval last year. But now, with delinquency rates climbing, especially if you've had even one late payment, lenders are tightening their requirements. You might need a bigger down payment or face higher rates. And if you're in Toronto, Vancouver, or Ottawa, listen up. Toronto's delinquency rate jumped almost 20% to 2.27%. Vancouver's up over 18%. These are the exact markets where housing is most expensive, and now credit stress is highest. It's the perfect storm. But here's the opportunity everyone's missing. While your peers are maxing out credit cards and missing payments, you can position yourself as the ideal borrower. Right now, before the holiday spending hits, is the critical moment to get your credit profile in order. Here's what you need to do immediately. First, check your credit report today, not next week, today. One incorrect late payment notation could cost you tens of thousands over the life of a mortgage. Dispute any errors now. Second, if you're carrying credit card balances, prioritize paying those down aggressively. Even reducing your utilization from 70% to 30% can boost your score significantly in just a couple of months. Third, and this is huge, avoid opening any new credit before applying for a mortgage. I know those holiday sales are tempting, but that new credit card for 10% off, it could tank your mortgage approval. The Equifax report specifically called out that credit card spending typically rises during the holidays, and the next few weeks will be decisive for Canadian consumers. Translation? This holiday season will determine whether you're positioned as a strong borrower or join the statistics of missed payments. Here's the reality check. If you're planning to buy a home or refinance in the next 6 to 12 months, what you do in the next 30 days with your credit matters more than ever. Lenders are watching these delinquency trends closely, and they're already adjusting their criteria. Ready to position yourself as the borrower lenders are fighting over instead of the one they're rejecting? I'm offering a free credit and mortgage readiness review to the next 10 people who message me the word ready.